Today we are going to address a common problem when starting in trading, being overwhelmed by the different trading styles. When you begin trading, it's easy to feel inundated by terms like day trading, swing trading, scalping, and many others. However, we are here to help you untangle this confusion and find the trading style that suits beginners best. The issue with trading when starting out is that you can quickly be inundated by the multitude of available trading styles. Each style has its own characteristics, rules, and strategies, which can make it difficult to decide which one is best for your needs. Let's take a moment to briefly explain some of the most common trading styles. 1. Day trading. This involves buying and selling financial assets within the same day, taking advantage of small price fluctuations. It requires constant market monitoring and quick responsiveness. 2. Swing trading. It involves holding positions for several days to a few weeks to take advantage of larger price movements. It requires in-depth technical analysis to identify trends and opportune entry and exit points. 3. Scalping. This is about making small profits by quickly opening and closing positions, often within seconds or minutes. It demands high execution speed and the ability to manage risk. The list of trading styles could go on, but it's important to understand that each style has its own requirements, advantages, and disadvantages. However, for beginners, this can be overwhelming and create confusion that can hinder progress. When you're starting out, it's best to focus on a trading style that is easier to understand and implement. That's why we often recommend swing trading to beginners. First of all, swing trading offers the advantage of significantly reducing the stress associated with daily market fluctuations. When engaging in short-term strategies such as day trading or scalping, you need to constantly monitor price movements, make quick decisions, and react to rapid market changes. This can be extremely stressful, especially for beginners who have not yet gained the necessary experience to make fast and accurate decisions. On the other hand, swing trading allows you to take a step back from the daily market fluctuations. You don't have to constantly monitor your positions or react immediately to price movements. Instead, you can take a more relaxed approach and analyze longer-term trends. This means you don't have to be glued to your computer screen all day, allowing you to dedicate your time to other activities and achieve a better work-life balance. Secondly, in day trading and scalping, where positions are often held for short periods, traders are more likely to place narrower stop losses to limit potential losses. However, this can also expose them to higher volatility and rapid price fluctuations. Stop losses are more likely to be triggered in these short-term trading styles, which can result in premature exits from positions and more frequent losses. On the other hand, in swing trading, traders tend to use wider stop losses based on longer-term support and resistance levels. These levels are generally less sensitive to daily market fluctuations. By placing wider stop losses, long-term traders give their positions more room to withstand short-term fluctuations and market noise. Now that we have discussed swing trading as the easiest and most profitable style for beginners, here are some practical tips to help you get started. 1. Establish a solid trading plan. This includes defining your goals, identifying the strategies and analysis tools you will use, and managing your risks. A well-defined plan will give you clear direction and help you make more rational decisions, rather than acting impulsively. The first step is to define your trading goals. Determine what you want to achieve, whether it's building wealth, generating a regular income, or funding a specific financial objective. Your goals will serve as a compass, guiding you in your trading decisions and helping you stay focused on the overall objective. Next, identify the strategies and analysis tools that align with your goals. Research different trading strategies and find ones that best suit your trading style and risk tolerance. This can be swing trading, trend following, or any other approach that resonates with you. Additionally, familiarize yourself with technical indicators, chart patterns, and other tools that will help you analyze market trends and make informed decisions. 2. Learn and practice technical analysis. Technical analysis is a vital tool for understanding past price movements and predicting future trends. Familiarize yourself with different technical indicators such as moving averages, Japanese candlestick patterns, and Ichimoku. Also, learn to identify key support and resistance levels on charts. This knowledge will enable you to interpret market movements more deeply and make more informed decisions. We encourage you to subscribe to our channel and watch our videos as we delve into these topics, detailing various technical indicators, candlestick patterns, and support and resistance levels. Regular practice of technical analysis will help you develop your skills and understanding of the market and assist you in identifying potential trading opportunities. By developing a solid trading plan and becoming familiar with technical analysis, you give yourself the best chances of success as a beginner trader. You will be able to make more informed decisions and seize opportunities that arise in the financial markets. Remember to manage your risks responsibly and remain disciplined in executing your trading plan. 3. Using stop-loss orders. First and foremost, stop-loss orders provide a predetermined exit point for your trades. By setting a specific price level at which your position will be closed, you establish a clear boundary beyond which you are not willing to risk further losses. This level of predefined risk helps protect your capital and prevents catastrophic losses that can significantly impact your trading account. Moreover, stop-loss orders allow you to maintain discipline and emotional control in your trading. Emotions can often cloud judgment and lead to impulsive decision-making, causing traders to hold on to losing positions for too long in the hope of a reversal. By using stop-loss orders, you detach yourself from the emotional aspect of the trade and let the predetermined level dictate your actions. This ensures that you make rational decisions based on your risk management plan, rather than being swayed by fear or greed. Another advantage of stop-loss orders is their ability to provide peace of mind. Trading inherently involves uncertainty, and the market can sometimes exhibit sudden and unpredictable movements. Having a stop-loss order in place frees you from constantly monitoring your positions, as you know that your risk is limited. This allows you to focus on other aspects of your trading strategy and reduces stress, enabling you to make more objective decisions. Stop-loss orders also offer flexibility in adjusting your risk exposure. As market conditions change, you can modify the placement of your stop-loss orders accordingly. For example, if a trade starts moving in your favor, you can adjust your stop-loss order to a level that locks in profits or reduces the risk to break even. This technique, known as trailing stop-loss, allows you to protect your gains and potentially maximize your profits in trending markets. 4. Manage your risk with proper position sizing. Managing your risk through proper position sizing is a key aspect of responsible trading. By limiting the size of your positions in relation to your total capital, you can effectively control your risk and protect your portfolio. Here's why implementing a position management strategy is essential. Firstly, adhering to a predefined percentage of capital risked per trade helps safeguard your overall investment. By allocating only a small portion, such as 1% to 3% of your capital to each trade, you minimize the impact of any single loss on your portfolio. This conservative approach ensures that a series of consecutive losses doesn't significantly deplete your trading account, allowing you to sustain your trading activities over the long term. Furthermore, proper position sizing allows you to capitalize on profit opportunities while maintaining risk control. By risking a predetermined percentage of your capital, you strike a balance between maximizing potential gains and preserving capital. This approach ensures that no single trade has the potential to wipe out a significant portion of your account, providing stability and longevity in your trading journey. 5. Be patient and disciplined. Patience and discipline are essential qualities for successful swing trading. In this strategy, it is crucial to exercise restraint and wait for the opportune moments to enter and exit trades. Rather than reacting impulsively to every market movement, take the time to analyze the market conditions and identify trades that align with your carefully crafted strategy. By maintaining discipline, you can resist the temptation to deviate from your plan based on short-term fluctuations. Adhering to your trading plan is paramount. It serves as your roadmap and keeps you focused on your long-term goals. Emotions can easily cloud judgment and lead to impulsive decisions that deviate from your original strategy. By sticking to your plan, you can overcome the urge to chase after every market movement or abandon your strategy during periods of uncertainty. Patience plays a crucial role in allowing trades to develop according to your analysis and criteria. Rushing into trades without proper evaluation can lead to poor outcomes and unnecessary losses. Take the time to gather sufficient information, conduct thorough analysis, and wait for the optimal setup before executing your trades. Discipline is the foundation of consistent profitability. It enables you to maintain a rational and objective mindset, even in the face of market volatility or unexpected events. By exercising discipline, you can resist the urge to deviate from your plan due to fear or greed. This level-headed approach helps you avoid costly mistakes and ensures that each trade is based on sound reasoning rather than emotional impulses. Subscribe to our channel for more tips. We have created a comprehensive library of relevant content that will help you improve your trading skills, both technically and psychologically. Our goal is to support you in your education and provide you with the necessary knowledge to avoid common mistakes and maximize your chances of success.